Hi, thanks for your interest in Cordant. My name is Isaac Presley. I'm the CEO and head of Cordant's investment committee. So in this video, what I would like to do is walk you through our investment philosophy, how we think about as a firm and for ourselves individually, approaching this question of what to do with our money. Now, there are three main approaches that people take when it comes to an investment philosophy, three big buckets. First one is what I would call the traditional strategy. So this is where you or a manager on your behalf attempts to beat the market via stock picking or manager selection. Number two is an indexing approach, which simple, it's low cost, can provide market returns, if you stick with that strategy over time. And then the third approach, which is obviously the approach we're going to take, combines kind of the best of both of those. So it combines, the low cost, the tax efficiency of index investing, but also still gives a chance for outperformance. And we'll talk about that here in a second. First of all, what I wanted to take a look at is the traditional approach, and why don't we buy into this? Kind of the first tenet here is not trying to outguess the market, because this traditional approach simply doesn't work. If you look at the data, this is basically a recent 20-year period, and the track record is not great. So at the beginning of this period, there were about 2,800 different stock or equity mutual funds. And again, these are highly compensated, highly paid, highly skilled people trying to outperform the market. And over that period, only 44% of them actually even survived. Most of the funds that get shut down are not because they're outperforming, it's because they're underperforming. So less than half even survived, and those that did, only 18% of them are winners. So pretty small chance that you're going to outperform the market via this approach. Same kind of story it goes for fixed income or bond investing as well. Now, say you did identify one of those 18% that did outperform, what's the chance that the manager that outperformed in the past is going to actually outperform in the future? So again, track record's not great. This is looking at a recent 10-year period. And what it's doing is taking the top 25% of the managers, so those that did outperform over the last 5 years, and looking at how they do in the next 5 years. And again, track record's not great. Only 21% of the 25% end up outperforming in the next period. So it's really hard to outperform via this approach. And notwithstanding, these tend to be expensive and high tax consequences of investing in this fashion. So that's led to this big swell in the index approach. Think Vanguard, etc., where you're basically just buying the entire market. And this has been a good approach if you can kind of stick with this strategy over time, go back almost 100 years, and the capital markets have rewarded long-term investing, capturing what the market provides. And so here we're just looking at inflation, treasury bills, government bonds, and then starting to get up into some more attractive returns, obviously, large cap stocks and small cap stocks. So this can work, turns a dollar into over $28,000 over this period in the case of small cap investing. So this index approach does work. It does come with some trade-offs. There are some pros and cons. Pros, again, it's low cost, it's a low turnover, and to the extent that you stick with the strategy, you're going to get the market returns. The cons are there's going to be some forced trading, something called index reconstitution, when the indexes have to rebalance back to the index constituents. Everybody knows what those are, and there can be some front running or extra cost there. And then there's a prioritization of tracking that index versus returns. Next chart just simply shows that kind of forced trading around this date. Costs tend to rise, and that's not beneficial to you as an indexed investor. So what we're going to try to do on our side is, again, take the best of what the index can provide, which are a number of things, and pair that with a chance of outperformance. So how do we do that? What we do is tilt our portfolios to what you could call dimensions or factors or characteristics of stocks that historically have led to higher returns. These are things that have been identified in the academic research. They show up in the data. They also make kind of intuitive economic sense. So these are things like the market. The market should return more than bonds or cash over time. You're taking more risk. You would be expected to have a higher return. That one makes pretty good sense to people. The other ones are, smaller companies over larger companies, cheaper companies over expensive companies, and highly profitable companies over companies that are less profitable. So again, those can make some intuitive sense. A smaller company is going to be more risky, but it also has more room to run, more room to grow. And so therefore, you would expect a higher return for that. So there's some good economic rationale for that. So how do we do that when we're building portfolios? Essentially, we're building a portfolio that tilts the holdings in some of these directions. So, start with the market here on the left. You just own everything. And then what can we do to actually own more of the small company, more of the cheaper companies, and more of the companies that are high in profitability? These yellow dots here, companies that have some higher profitability characteristics. So that's the whole idea, is start with the market and then kind of tilt in the direction, still building a diversified portfolio, but tilting in the direction of these stocks or characteristics that you would expect a higher return going forward. So how has this played out over time? Here's the data, basically going back as far as we can in these different markets: U.S. stocks, international stocks, and then emerging market stocks. Going to be a different time period for each of these, but going back as far as we can, and you can see whether you're looking at size, price, or profitability. Tilting in these directions lead to an outperformance over the full date period across markets and across factor. Now, one thing that you need to keep in mind is that these tend to work over time, but they don't work in every single year. So just like the stock market doesn't outperform cash every year, there's going to be some down years. The same thing is true for these different factors. The red bars in these charts indicate underperformance of that factor. The green bar would indicate outperformance. So just like the market doesn't outperform cash every year, small caps don't outperform large caps, value doesn't outperform growth, and high profitability does not outperform low profitability. We've recently gone through a kind of a tough stretch, whether it's for small cap or for value, as growth, kind of these mega cap growth tech names have outperformed. But again, over a longer time period, these have tended to outperform, and as they are cheaper relative to the market, you would think the prospects going forward would be quite good. Okay, so hopefully that gives you a good idea of how we approach investing and structuring portfolios to clients. If I were to try to boil it down into just a crisp 50 words, here's what it would look like. So first of all, we're always going to approach investing success as achieving your goal. That's always going to be our target. We're going to take a view that markets are mostly efficient. We can tilt and try to outperform, but trying to outperform being stock picking or forecasting doesn't tend to work. Risk and return are linked, so we must allocate intentionally. We want to tilt, like we looked at, towards stocks with higher expected returns. Rebalancing is important. Don't time the market, but do rebalance systematically. We're a big believer in broad diversification, whether that's across countries, asset classes, or different stocks. We want to minimize unnecessary costs. So these are things like trading costs or expense ratios, things like that. And then taxes matter a whole lot as well. So we're going to pay attention to that. And then lastly, I would say don't pay the panic tax. Whatever strategy you're employing for your portfolio, it's important to have confidence in that and stick with it over time. Okay, hopefully this helps give you a good idea of our investment philosophy. If you have any questions, obviously reach out to me or the team. We'd be happy to talk more about it. Thanks.